The collapse of Silicon Valley Bank has sent shockwaves through global financial markets, with economists predicting that it could have a ripple effect on interest rates set by the world's most powerful central banks. Rapid increases in borrowing costs over the past year have caused financial stress, leading to concerns that central banks may halt their plans to raise interest rates. Please make sure to subscribe to the channel. As a result of the crisis, experts suggest that the U.S. Federal Reserve is likely to keep interest rates on hold at its upcoming decision next week. The implications of this development are significant and could have far-reaching consequences for the financial world. The uncertain times we find ourselves in have made it clear that even the most powerful institutions are not immune to unexpected shocks. It remains to be seen how the situation will unfold and what impact it will have on the global economy. The banking industry is currently facing concerns over the possibility of contagion spreading, which has led to a reduction in financial market expectations for the Bank of England and the European Central Bank to increase interest rates. On Monday, Goldman Sachs predicted that the U.S. Federal Reserve would keep rates steady at 4.5% to 4.75%, after previously expecting another rise. The bank's analysts wrote in a note to clients that due to the stress in the banking system, they no longer expect a rate hike at the Fed's next meeting on March 22, as opposed to their previous expectation of a 25 basis point hike. They further suggested that the central bank would increase rates by 0.25 percentage points in May, June, and July to counter high levels of inflation, with rates peaking at 5.25% to 5.5%. Despite this prediction, the analysts added that there is considerable uncertainty about the path ahead. The ongoing situation emphasizes the importance of closely monitoring global financial markets, as unexpected events can have far-reaching consequences. It remains to be seen how these developments will impact the banking industry and the global economy as a whole. Financial Services Group, Nomura, has predicted that the U.S. Federal Reserve will take drastic measures by cutting interest rates at its upcoming meeting next week. In a newsletter, the analysts at Nomura wrote that they expect a rate cut of 25 basis points and a halt of balance sheet reduction in March, with the possibility of a new lending facility. This prediction is a significant departure from the expectations of financial markets just a week ago, when a rate increase of 0.5 percentage points was anticipated. The Fed chair, Jerome Powell, had previously warned that more rate hikes would be required to cool inflation. Traders in financial markets had been almost certain that the Bank of England would raise rates by 0.25 percentage points at its upcoming meeting on 23 March. However, as Citi traders assessed the consequences of Silicon Valley Bank's failure, the probability has fallen to a 71% chance. Economists have suggested that the failure of SVB will likely cause banks to exercise greater caution when issuing loans, which could have a similar effect to higher borrowing costs. However, they also highlighted that the collapse of SVB showed that the impacts of the most aggressive rate-rising cycle in decades were finally starting to take effect. John Briggs, the global head of economics and market strategy at NatWest, commented that the Fed's actions were starting to break things. He predicted that the Fed would most likely opt for a more cautious approach by leaning towards a 25 basis point rise, instead of the previously expected 50 basis points. John Briggs added that if the Fed's tightening actions were already causing damage, it may not want to risk further damage by continuing down the same path. Silicon Valley Bank's collapse was a result of its significant investments in U.S. government bonds 2 years ago, when deposit levels were high, primarily from the tech sector and venture capital investors. As the Fed continued to raise interest rates, the value of these investments fell, and the bank faced increasing pressure to return cash to depositors as the tech sector weakened. SVB announced on Monday morning that it would acquire SVB's UK operations for just £1, following a weekend of emergency talks between the UK government, the Bank of England, and potential suitors. The full impact of SVB's collapse on the wider banking industry remains to be seen. According to analysts at Deutsche Bank, Silicon Valley Bank's collapse was a result of several factors, including its significant exposure to tech venture capital depositors who were struggling due to the bursting of the tech bubble. Additionally, the bank had loaded up its balance sheet with positive carry trades into bonds when deposits soared during the ultra-low rate environment in 2021, leaving it vulnerable to the rising interest rates. Deutsche Bank analysts also pointed out that three factors hit the bank, including tech companies' requirements for cash, higher deposit rates offered by other banks as interest rates rose, and finally, fear over the stability of SVB after it sold $21 billion of its bond portfolio for a steep loss last week. Ultimately, this led to an irreversible bank run.